I want to go over 5 tips how to avoid the most common RMD mistakes. All right, today we're going to go over 5 tips how to avoid the most common RMD mistakes. And actually, this is going to be part 1. Actually, there's going to be 10 tips total, but we're just going to go over 5 tips today how to avoid these mistakes. Required minimum distributions. That's what RMDs stand for. If you have an IRA, a 401k, a 403b, a 457 plan, a TSP, you have to pay taxes on this money when you take money out. So when you invest that money, you get a tax deduction when you contributed, and now the IRS says we've been patient long enough, it's time to take money out each year and pay taxes on that. So let's start with tip number 1. You have to understand when you take out your required minimum distributions, which we call an RMD. The year you turn 72. The old number was 70 and a half, and you might be grandfathered into that, but in 2019, late 2019, the Secure Act was passed, which postponed RMDs till age 72, and that went into effect in January of 2020. So if you're turning 72 this year, you have to take out your RMD by the end of the year with a little caveat to it, which means you can actually postpone your first RMD till April 1st of next year. So you can actually push your first one out a little bit till April 1st next year, but then you can only do that for your very first RMD. And if you postpone it till April 1st next year, you have to take it out, a second one out by the end of the year. So nobody wants to take out 2 RMDs in a year, so just get in the habit of taking out your RMDs on a yearly basis. So again, if you're 72 this year, you want to be taking it out by the end of the year, okay? Unless you postpone it. Number 2, if you miss your RMD, what is the penalty? I've had a lot of people I've worked with through the years, before they became clients of mine, they missed their RMDs or several years of RMDs. And what's the penalty? One of the biggest penalties out there, 50% penalty from the IRS of what you're supposed to take out. And let's lead that to number 3, because how do you calculate what you're supposed to take out? So there's a table. It's the RMD life expectancy table, and that determines what you have to take out each year. So we're going to look at, let's just say you have $1 million and you're 72 this year. There's a factor that says you have to take out 3.65%. And they actually look at it as a divisor. You divide $1 million by 27.4, which is considered your life expectancy at 72. Isn't that nice, right? If you're going to live till 99 in 4 months, 99 and a half roughly. So if you have $1 million, what they base that on is December 31st balance of last year. So they look at what your balance was last year, divide that by 27.4, which is the same as multiplying it by 3.65, and it means your RMDs are $36,500. So going back to number 2, if you didn't take it out last year, or this year, whenever your RMDs are, the penalty is half of that. So if it's $18,250 penalty if you miss taking your RMDs. So we'll put this table up there so you can see what that table looks like. And every year you get older, you have to take out more money, a higher percentage of your previous year balance. There's going to be another table we're going to put up here as well. If you're married and if your spouse is more than 10 years younger than you, there is a different table that you have to take your RMDs from. It's a little bit different. They have you take a little bit less out. So let's just say you're 72 and your spouse is 60. Well, the factor is 28.8, which turns out to be a little bit smaller percentage you have to take out. Instead of 3.65 or the standard table, you have to take out 3.47. It's just a little bit less. You're taking out less than $2,000 less than what you had to from the standard table. So instead of taking out $36,500 off of $1 million, you'd have to take out $34,722.22. So, and it's different. So if your spouse is even younger, you take out even less. So there's 2 different tables. Most of us will use the standard table, but if your spouse is more than 10 years younger, there is a different table for you. Number 4, this is one that gets missed a lot. So if you have multiple different type of retirement accounts, just say you have 3 401ks, your previous employers, and you retired, so you have 3 401ks and you have a couple IRAs. The IRS, even though you get taxed the same when you take your RMDs out, they're going to make sure you do it different. Your 401ks, you have to take them out individually. Your RMDs have to be separate from each 401k. And if you have multiple IRAs, the IRS says you can take enough RMDs out of one IRA for all your IRAs. So if you have 2 or 5 IRAs, you can add up all the RMDs collectively and take it out of one if you choose to. But you can't do that with your 401ks. And a lot of people have made that mistake, and they've called me up and said, Mike, I took my RMD from my 403B or my 401k, so I'm not going to take my RMD with you this year. And I have to let them know you can't do that. I wish you would have called me first, because we still have to take it out of your IRAs. You cannot take money from an employer sponsor plan to cover the RMD for an IRA. And here's the thing, if you miss it and the IRS catches up, that's a 50% penalty of what you're supposed to take out. So even though you took enough money out, you took it out of the wrong account. And the IRS can still penalize you a 50% penalty because you didn't take it out of the right account. And let's end with the last one as well, which is getting to be more popular and getting to be a big issue, is if you have an employer-sponsored plan Roth, like a Roth 401k, a Roth 403b, a Roth TSP, a Roth employer's deferred comp, a 457 plan. The IRS, if you leave that money there when you're 72 and older, you still have to take an RMD from that Roth account. People say, no, I already paid taxes on that money. I understand. I understand you already paid taxes on that Roth. But the IRS says if you leave it there when you're 72 and older, you have to take an RMD from that Roth account if it's in that employer sponsor plan. Now, you don't have to pay taxes on that money because you already did, but you're required to take the money out and take it out of that account. Now you're losing a small percentage of that money that cannot grow tax-free anymore. So that's just another indicator. Don't leave those Roth employer sponsor plans in the Roth. Get them rolled out of there before you're 72 so you won't be required to take an RMD from that Roth account. Once you put it into a Roth IRA, you are safe from taking RMDs from that Roth. As long as you roll it to a Roth IRA, you won't have to take those RMDs. Hopefully these 5 tips will help. We have 5 more tips to go over next week, more common mistakes. If you like this information, you have questions, just respond back, hit that like and subscribe, please.